Last week's COTS report was delayed, but it was well worth the wait. We have long-term trends that are continuing and also some key reversals you may not have anticipated. Of course, we're talking about the COT report, Commitment of Traders. It's issued weekly by the CFTC. It shows us the largest positions in the futures market, held by large traders, hedge funds, institutions. It gives us an indication as far as market sentiment and sometimes trend signals. It shows us where the smart money is going, where the most experienced traders and institutions are placing their bets. Let's starting out with gold. Those tall blue bars, those are long positions held by the money managers. Money managers are trend followers. They go with the trend. And they're now long 168,000 contracts on gold versus last week's 161. In fact, this is the highest I've seen in quite a while. Compare that to the short positions, the 37,000 print. That is a very large divergence. The money managers are very much long gold. They're also long silver too. Those tall blue bars, 63,000 contracts, increasing from last week's 60,000. Again, the highest high we've seen in quite a while. There is no mistaking a long-term trend held by silver and gold and the money managers that have done quite well. Let's move to the foreign exchange market because this is actually complementary to the metals. Starting off with US dollar. Now, those short green bars, those are the long positions held by the asset managers, otherwise known as the money managers. Again, trend followers. Now, the long positions did increase to some extent, but still very much overall short compared to the 11,200 short contracts, those tall purple bars. So the US dollar in a long term trend to the downside, that is very much confirmed by the money managers. But not only that, notice that tall blue bar, 93,000 contracts. Those are the long positions held by the dealers. Now, the dealers take a different role within the market. When we buy the US dollar, the dealer usually goes short. They're selling us the dollars. So we see a tremendous amount of confirmation when the asset managers are long and the dealers are short. Or in this case, the trend followers, the asset managers are short the US dollar and the dealers are long. How about the euro? Well, the euro's been very strong. Those tall green bars, those are asset managers. They're very much long the euro. In fact, they're adding to their long positions. But notice that tall red bar. They're also adding to their short positions from the dealer side. It's a perfect opposite picture. The asset managers are long the euro, the dealers are short. Again, extra confirmation that the euro most likely is in the long-term trend to the upside. We'll compare the weak dollar to a strong euro. No surprise, long-term trend to the upside does exist. And based on this week's COT report, well, it suggests there's a little reason to think this is going to end anytime soon. How about the British pound? Interesting development here. Last week, that tall green bar, 72,000 long positions. This week, 66,000. The purple bars, last week, 68,000 short positions. Now, 73. So the long positions have fallen, the short positions have risen. In fact, they've completely flipped. According to the asset managers within the COT report, they flipped from net long to net short. Also, notice that tall red bar on the right-hand side, 42,000 contracts. Those are the dealers. The dealers have very much pared back on their short positions. Extra confirmation again. So when we see a continuation, or we should say a reversal, where now they're net short the pound, but they've also pulled back on the dealer short positions, well, that's usually a key indication of a trend reversal, to say the least. Here's a New Zealand dollar, the Kiwi, another reversal. They were net short the Kiwi dollar, the New Zealand dollar last week with 96,000 contracts, now 17.8. Conversely, large short positions last week, 26.8, now only 11.9. So we see another flip, but in this case to the long side in terms of the Kiwi. To wrap up the foreign exchange market, the most significant trends that we see here, US dollar, asset managers, they're slightly more bearish. They're adding to their short positions. The dealers are building even more long positions. Meanwhile, the asset managers are adding to their long positions on the euro. It's the opposite picture. Remember that euro dollar chart? Nice healthy trend to the upside. The dealers are increasing the shorts. The British pound has now flipped to a bearish position, whereas the New Zealand dollar has flipped to a bullish position. All this is very much complementary to the metals market. We know that dollars in a long-term trend to the downside. Well, a weak dollar usually is, a good thing for metals. Metals like gold and silver usually go up under a weak dollar climate, and this is very much what's happening right now. Now, to digress just for a moment, the industrial production capacity utilization numbers, they're key economic figures within the manufacturing sector. They're widely misunderstood. Actually, very simple and very, very important. We spoke about this in our Substack newsletter published just yesterday. We'll provide you a link in the description of this video. But essentially, this is the way it works: capacity utilization in blue, industrial production in red. They usually go in the same direction. There's a strong correlation over the long term. What are they? Industrial production measures the factory output. Imagine standing at the exit door of a factory, counting how many widgets they produce. That's industrial production. Capacity utilization measures the percentage of the total resources that are actually being used by the factories. So when there's optimism within the economy, capacity utilization will rise. When they're pessimistic, when they're nervous about the prospects of manufacturing, capacity utilization falls. Well, we took a look within this article at key events within stock market history, economic history that shows us reversals. So, for example, the Asian financial crisis, late 90s, capacity utilization in blue was diving lower. Meanwhile, industrial production was rising. What happened here? Well, the manufacturers, they pulled back a lot on their capacity. They sensed trouble on the horizon. Meanwhile, industrial production, remember, that counts the amount of widgets or products that are produced. That's a lagging indicator. It didn't yet move to the downside because it was still counting goods that were produced yesterday and last week. Compare that to the financial crisis of 2008. That was a more broad-based economic slowdown where capacity utilization and industrial production both trended lower, almost simultaneously. Well, we fast forward to present day where industrial production, it's kind of treading water, but at the same time, capacity utilization is actually quite weak and weakening by every monthly report. We discuss the implications of this and what this means for the manufacturing sector and the overall economy moving forward. Just as a reminder, we've published this and many other articles in our Substack newsletter, and again, we'll provide a link for the newsletter in our description of this video. We hope this has been helpful. We look forward to seeing you back soon.